probably seen the headlines that mortgage delinquencies are up by 30% year over year, and that's an alarming number. But what does that mean for home buyers and sellers in this market? Stay tuned, let's talk about it.
Look, I get it. The Toronto real estate market is confusing. Whether you're a new or experienced investor or just looking for a home to raise your family in, join us at Broadview Table Talks as we sit around the table with my friends to talk about the real estate and the ever-changing market in Toronto.
Mortgage delinquency is typically when a person misses their payments, 3 payments or so, 90 days or more. That's when they start counting it. An alarming number that's been going up to is 31 basis points. So if you know what a basis point is, that's 0.1% of 1%. If we're talking about 31 basis points, it's 0.31% of people out there that are missing on their payments for 90 days or more. Yeah, while it's pretty low in the overall aspect of it, it does sound an alarming fact. Okay, so the number of mortgages out there in Canada are around 6 million roughly. And traditionally in Toronto, it's around 900,000 or so that of people have mortgages. Roughly about 38 to 40% of households that have a mortgage. So you got to think 60% or more of people don't have a mortgage, which is a great position to be in. If you do have a mortgage and you're missing those payments, it sounds like a little bit, but it actually could signal something bad. If you look at a bank, their lending portfolio typically is about 40% comes from mortgages. And if people are missing payments, even though it's a small number of people, and let's just say it's risen by 30%, okay, so it went from 0.24% to 0.31%. Not the end of the world. It's not going to be huge, but banks don't lose money. You got to realize that. What's causing of people defaulting? Well, it's the mortgage renewal wave. So if you remember back in the pandemic, 2020 is when it all started, rates were down to near zero rates. You can get a mortgage for 1% to 2%. A lot of people had a great time with that, especially if you did a fixed rates. But from 2022 till now, if you're doing a 5-year fixed rate mortgage, that's 2025 today. Rates are at like what, 5%? You know, at the high peak, it went up to 8%, as you guys all remember, hopefully. Now we're at the 5%. It's not the end of the world, but if you're coming from 1% to 2% and you're going to 4% to 5%, it does become as a big payment shock. Some people, even back then, were kind of at their limit. Doubling the interest portion of their payments, let's call it roughly 15 to 30% of their payment increases they're going to have to increase. That could be a big shock to some people. I think there's roughly 60% of mortgages that are yet to renew, and it's going to happen this year. That could impact a lot of people. Then later on that, with all the tariffs and all the stuff that's happening with the economy, you can see why there's a chance that there's going to be more and more mortgage defaults. And if you see more and more mortgage defaults, people are in payment shocks and they can't sell. I mean, I helped 2 power sales this year so far. It's not a pretty situation. If you're missing 3 mortgage payments or more, it probably means you're in a pretty rough situation. If the market values have dropped by 20-25% and you're underwater in the mortgages, banks are going to try to recoup as much as they can. So that basically is all their equity that's gone, and now the banks are going to lose money. Yeah, they set aside some money, provisions for loan losses is what they call it. They set aside a few $100 million, maybe up to $1 billion of money to basically cover in case they have a shortfall and they're losing money. But if you're a bank and you're selling something and you lose a bit of money on it, it's not the end of the world. They just want it off their books because they're accountable to their money that they have in the banks as well too. They have to pay back bonds and the bank stocks as well. So they have to have a performance on their money as well. They're held to a higher standard for returns. If that happens, if the banks are starting to lose money, that's a big problem. You got to think about the spin-off that happens to it. People that hold bank stocks, pension funds, all these large corporations that buy the bank bonds, expecting it to be stable. A lot could destabilize the financial world if that happened. And another big impact that could happen out of this is that if banks start losing money on their mortgages, how much of their appetite do you think they will be to be out there to actually lend more money? And every day there's transactions happening, at least in the GTA, 65, 70,000 transactions every single year. So that's a lot of people that have to move every year. And if the banks aren't willing to lend mortgages and they're only picking the best of the best, how many people are the best of the best borrowers? They're going to tighten up their lending criteria, and then their profits are going to dry up, and it becomes this endless loop of just downward spiral of losing money. So they're going to lay off people, and it kind of gets really nasty. It's almost like a little mini recession, if you will, right? That's not good news for the economy overall if this starts happening. Because then if there's a sale that happens and it sets the market value a little bit lower, it just sets the overall portfolio even lower. And the assets that the banks are lending on, that value shrinks as well too, and then it's just a downward spiral. So how it could play out is that there's households that are having tighter budgets, they're spending less on restaurants and services and goods and things like that. Everything that drives the economy, it just means more of a recession. That's not good, especially if people can't keep up with their payments. So for buyers, what does it mean? It just means that you can have more choice. We're right in the start of the September market. I know some people are still on vacation, but essentially it's back to school for a lot of people. So everyone's off to the races. I'm starting to see more and more listings come on the market, and good ones as well too. So for buyers, it means more choice. choice. I just wouldn't expect a flood of listings to come on the market. Like historically, 0.31% up from 0.24% of delinquencies is not the end of the world. And if you're buying a power sale, chances are they're not really taking care of the place because they can't afford to keep up with their payments. So don't expect to buy something amazing. When you buy a power sale that has broken blinds or issues or something like that you just can't get fixed, the bank is not fixing it. There potentially could be other liens on the property as well too. Like you're supposed to get free and clear title. But what happens if a contractor comes in afterwards and says, hey, that guy still owes me money, I'm not getting it, then all of a sudden you have a title insurance claim, right? And hopefully you got title insurance when you're closing the place. So it could be a lot. And for sellers, if there's more and more listings coming in the market and no one really buying because the economy is tanking and everything's just coming on a downward spiral and nobody can get qualified for mortgages because banks aren't lending as much, then it just means that you have to position and price your property even better, meaning that you have to price it even lower in order to get your place sold. And if you're an investor sitting on some cash, you might think that this is a great time to buy something and just snap something up from somebody else's misery. The problem with that is that we don't see a lot of foreclosures in Canada and Ontario. It's mainly power of sales. And with power sales, you have the duty to get the highest price possible, put on the open market and make sure you have a competitive bid. Because otherwise, if you if you took the home back from somebody that was delinquent, like they potentially could sue you because you're saying like, hey, you did something shady here. You didn't get the highest and best price to try to save my money, that equity that I have in it. They can potentially get sued and they don't want that. So there is a court proceeding that you have to go through to get power sales done. Foreclosures, on the other hand, are different where the bank possesses or the lender repossesses the property and now it belongs to them. So they can do whatever they want to it to sell it or keep it or whatever they need to do. So it doesn't seem like it's going to be a huge opportunity for investors. I usually find things on the open market, just regular people selling, you might be able to get a better deal by negotiating with somebody that has a lot of equity in their property that bought a long time ago. So yes, delinquency rates are rising in Canada and the GTA, but it's not as bad as what they were historically. We're coming from a very low base. Canada is very conservative when it comes to underwriting. So we're looking at 0.31% that are delinquent right now over 90 days in Q3 2025. In the US, if you compare to that, they're typically looking around 2 to 3% delinquency rates. And at the peak during the global financial crisis, it was up to 10%. The most we've ever seen is 1.03% in Canada. So I just don't expect it to be massacre everywhere. I don't see it to be blood everywhere. You could find a good deal out there. I'm not saying you won't. I'm just saying don't think it's just from the power sales situations. So in closing, I'm just saying don't get lost in the headlines. Make sure you look a little bit deeper. I know one headline might be conflicting from one source to another source. If anything, give me a call. Book an appointment in the link below.
Add it up.
Thanks for sticking out to the very end. I hope you got some value out of this. Do me a favor, please press like and subscribe, but more than anything, leave me some feedback so we know what to produce for you going forward. Thanks again.